Hello everyone, we're Gaspar, Antonella, Antonio, Marie, and Camilo, and today we're going to present to you the effect of the COVID crisis on France compared to Portugal from a macroeconomic perspective.
Okay, so first of all, we'll give a general overview for France and Portugal. To do so, we'll take into account the GDP per capita and then the GDP deflator. For this part, we took our data from OECD stats. In order to get the GDP per capita, we divide the economic output of a country by the population. It's an excellent indicator of a country living standards. It also explains how much the economy of a country benefits its population. We'll now look at the GDP per capita from 1995 to 2020. Overall, as you can see on the graph, France has a higher GDP per capita than Portugal. Both countries maintained a positive evolution of their GDP per capita over approximately 20 years, which means that the standards of living has increased over time. Both curves have the same shapes. For example, GDP per capita for France and Portugal dropped in 2019 by approximately 5,000, which means that the standards of living has decreased at that time, especially due to the beginning of the pandemic. So now we'll look at the GDP deflator. It's important to mention that due to the fact that it's not dependent on a predefined basket of commodities, the GDP deflator is more accurate than the CPI index. That's why we chose it. Overall, as you can see on the graph, both countries maintained a positive evolution of their GDP deflator over 25 years. Both curves have the same shape starting from 2010 onwards. From 1990 to 2014, we can see that for both countries there has been deflation relative to the base year. In fact, the GDP deflator was below 100. Then, from 2014 to 2020, we can observe that the level of prices went up. There was inflation of more than 2% at that period. In general, they had the same evolution except for 1990, where Portugal started at 40 and France at 75. To conclude on these two first graphs, we can see that France and Portugal, both in terms of GDP per capita and GDP deflator, are generally following the same trends. Again, in general, we notice that France is a little bit more advanced in both scenarios, which means that France has a higher GDP per capita for whatever years and somewhat higher GDP deflator. It's important to note that this does not represent only advantages for the economy. In fact, a high GDP deflator puts the country in more difficult conditions for growth.
Analyzing the GDP growth rates in both countries from 2015 to 2018, we can see that from 2015 base year to 2016, GDP grew 2% in Portugal and 1% in France. Portugal grew more, which can be explained by the crisis of 2008. Portugal increased more in that period of time than France. So in 2016, it grew more than France. From 2016 to 2017, we observed that France grew 2.1% and Portugal grew 3.7%. From 2017 to 2018, Portugal grew 3%, France grew 2%. So in this interval, Portugal always grew more than France.
To firstly analyze the GDP, we must notice that the GDP in France is much higher than in Portugal. Portugal seems to have a more cyclical GDP, while France is more steady and upward. They both increase though. Now we must analyze the percentage weights of each component of the GDP in both countries. So to start up with France, we realize that France has a private consumption that weighs for more than 50% of the GDP. Similarly, Portugal has also a weight for private consumption that is 50%. However, both of those weights have been decreasing ever since 1990. Now for net exports, so for France there has been a decrease in net exports weight since 1990. It went from 15% to 10% in 2018. Similarly, Portugal has had a decrease in net exports as well. As for gross fixed capital formation and general consumption expenditure, they have had a similar decrease in their weight. They decreased by 10% in 30 years, and it is the same for Portugal. Now, bringing the French GDP and its component together, we can see that the financial crisis, like the one in 2008, did not consequently affect private consumption, but it did harm net export and the growth fixed capital investments, since we observe a net fall in their rates. This resulted in a net decrease of GDP during the crisis. From this, we conclude that the component that drove down the French GDP during the crisis of 2008 was not private consumption, but net exports and growth capital formation, which those are the ones that have been affected the most. Another important characteristic of France's economy is high public debt, so reaching almost 100% of GDP in 2018. Budget deficit is common in France. It is indeed way higher than what is considered the 60% healthy limit for debt. There is an important difference between France and Portugal regarding public debt. In Portugal, public debt is 20% higher than in France, but France has a lower public deficit, which results in lower public debt compared to Portugal. Finally, regarding budget balance, France has a negative budget balance, which explains its budget deficit. However, compared to Portugal, France seems to have an even higher government budget deficit than France. France seems to have a steady budget balance, not going much lower, than -25%, but not much higher than -22% either. While Portugal ranged from -15 to -20.
To analyze the money market in both Portugal and France, we use the real interest rate. As we can see from the graph, it peaked at a level of 3.27 in 2009 in France, and it peaked the same year in Portugal at a level of 30.68. What this means is that at the peak of both countries, it was much more expensive to borrow money in Portugal. It's interesting to note that before the 2008 financial crisis, France always had a higher real interest rate than Portugal. And ever since the crisis happened, Portugal has had a higher real interest rate.
Regarding the labor market, the natural rate of unemployment of France and Portugal have a similar tendency to increase over the years, but at different rates. This difference can be supported by productivity, as France almost doubles Portugal in productivity, which is reflected on their respective minimum wages. Moreover, the average of unemployment benefits and the strictness of employment protection of Portugal are higher than in France, showing that the French labor market is almost 2 times more flexible and has less financial incentives to work. Furthermore, the constant decrease in workers that belong to unions leads to a decrease in their bargaining power, consequently a decrease in the natural rate of unemployment. Finally, France has short cycles with low amplitudes of recessions and contractions, with exceptions of 2000 and 2012, which shows the strength of their economy.
To introduce the short-term and medium-term impact of the pandemic, we first need to analyze the number of deaths. So France has had 2 peaks of deaths, one in March and one in April, which lasted longer. Those peaks are medium, while Portugal has had one main peak, which exceeded the number of deaths in France. For the confirmed cases, France has had more confirmed cases relatively to the total population. However, when we do the proportions, it is 11% of the France's total population that was confirmed case, and 10.5% of the Portugal's total population that was confirmed COVID cases. For the lockdowns, France has had 3 lockdowns and Portugal 2, which deeply affected the economies of both countries.
Investment maintains a steady growth in both countries. However, on the peak of the pandemic, it drops drastically. In quarter 2 of 2020, the biggest decreases in Portugal and France happened. Portugal drops 10% and France 16%. Yet they were able to recover in quarter 3 as the world starts opening again. Consumption behaves better than investment as people still consumed a lot during lockdown. However, online consumption increased during lockdown. Portugal decreased more during quarter 2 of 2020, decreasing 16.2%, and on the other hand, France decreased 12%. Both countries are able to recover quite well, growing 16% and 18.2% respectively. The trade balance of both countries achieves negative levels as exports are more affected than imports, which makes the trade balance negative. We can verify that Portugal gets a sharper decline than France in export and on imports. In Portugal, this decline is also worse than France's. This can easily be explained as France has a much higher GDP than Portugal. Talking about the interest rate, as we know, an increase in the interest rate decreases the demand for money as people put more of their wealth into bonds and vice versa. So we know directly that the demand for money in Portugal decreased and the demand for money in France increased. We have growing interest rates, borrowing money is more costly, people are going to spend less, and inflation will happen to fall. Also, since the demand for money decreases, the supply for money will increase as the interest rates are not lowered in this period. They're growing. People will also put more of their wealth into bonds. In the case of France, the opposite of Portugal happened. The country presents decreasing interest rates in the pandemic period in the short term. So the supply for money is going to increase. Borrowing money is going to be easier and cheaper. People are going to spend more and people are going to buy more stocks instead of buying bonds.
Now we'll talk about the effect of the policy response. So since 2018, at the beginning of the pandemic, we can see that both countries have increased their general government total expenditure significantly. This was in order to compensate for the bad effects of the pandemic on the economy. An increase in government spending, which is one of the components of aggregate demand, will push the demand curve to the right. In fact, an increase in G will result in an increase in production and demand. As a result, IS moved to the right, establishing a new short-term equilibrium in which money demand and interest rates are both higher. Going more into details, reduced taxes will result in greater disposable income, which will enhance consumption and savings, pushing the aggregate demand curve to the right. As productivity rises and the price of essentials inputs declines, the aggregate supply curve moves to the right, allowing for a combination of lower inflation, higher production, and reduced unemployment. An increase in aggregate demand will result in a rise in money demand. Only an increase in the interest rate can restore monetary balance. We will have a new equilibrium at the intersection of the new IS, who has shifted to the right, and LM, creating a new level of output Y, but this is only for the short term. The increase in demand enhanced production will lead to an increase in employment and a decrease in unemployment to offset the effect of the economic recession caused by the pandemic. This resulted in a rise in salaries and prices, causing a change in AS and a rightward movement in AD.
When it comes to the multiplier peaked in France in the second quarter of 2020, while in Portugal it peaked twice, in the fourth quarter of 2019 and in the third quarter of 2020. What this means is that at these high points, the economies in both countries were very volatile. And we can clearly state that the peak in France and the second peak in Portugal are related to the COVID-19 pandemic, as these were times where the economy was very volatile in both countries.
Due to the COVID crisis, France is entering a period of stagflation, meaning the economy is going through a period of low growth, high unemployment, and high inflation. However, France's unemployment curve has been increasing ever since the end of lockdown. Conversely, Portugal's unemployment rates remain stable, yet it is steadily decreasing. While France's employment is increasing, supply shocks are affecting the economy. We're currently observing an energy crisis with an increase of natural gas prices by 12% last October. To understand why this is considered as a supply shock, we shall explain the following. An increase in energy prices leads to an increase in the cost of production, leading to a decrease in the supply and therefore an increase in unemployment. On the other hand, an increase in the prices of petrol in both France and Portugal has been observed during fall of 2021 and over a short period of time. Similarly to the effect of the increase in energy prices, the increase in petrol prices has resulted in higher unemployment rate for both France and Portugal. As for the French and Portuguese CPIs, they both increased, following a more dramatic trend for France, with an increase of 1.7 between August 2020 and August 2021. This shock has caused a decrease in both supply and demand, leading to a decrease in production and an increase in unemployment. In the medium term, the pandemic in the labor market can be understood as supply shocks affecting the unemployment rate of Portugal, but mostly France's rate.
Regarding the medium-term policy response, both countries reduced their government expenditure following the fiscal expansion of 2020, and it is projected that it keeps decreasing in the medium term. This change in policy is done so that government expenditure can reach the pre-pandemic levels, as well as the interest rates. Furthermore, on the medium term, the policy implemented in 2020 only increases the price level, not the output. Moreover, this will allow France and Portugal to avoid the medium-term side effects of fiscal expansion, such as an increase in debt and inflation and a decrease in private investment that can cause a lower medium-term potential growth. So, this fiscal contraction is key, as they are trying to recover from a recession, and this would push the economy towards the pre-pandemic natural level of output, which was indeed higher than in 2020. It will also allow the natural output to increase in the medium term without depending on government expenditure.